Hello and welcome to BST Live. Glad you could join us today, where we're going to be talking about overcoming broken strategies. It's a great topic and we've got a great guest, so let's get to it. Well, hello and welcome. Good morning, good afternoon, good evening, wherever you are. It's morning here, Monday morning, and it's a bit of a cloudy day. I've got back from a walk, actually. It's a little bit humid, but here we are. Glad you could join us. We've got an excellent guest joining us today. We're going to be talking about overcoming broken strategies, which is a very applicable topic to systematic traders. And joining us today, we have Marsten Parker. Now, Marsten, welcome, Marsten.
Thank you.
Now, Marsten is an unknown market wizard, which we're going to, well, I should maybe say not so unknown market wizard now, which we're going to dig into today. And he's had a lot of experience in the markets, 20 plus years. And, he's done a lot of interesting things to adapt to the market and overcoming broken strategies. So I'm really glad to have you here today, Marsten. Welcome. How about we start with some background on yourself? Can you give us a little bit of an intro into how you got started in the markets and what markets you trade?
Sure. I had no interest in the markets whatsoever until I was in my 30s. I opened my first brokerage account when I was 36. And that was because I had started a software company with a few other people, and we went public in 1996. So I had stock, and once it became unrestricted out of the lockout period, I would need to diversify and then do something with the investment. So I opened a brokerage account, and I watched our stock every day. Obviously, I had a lot of interest in knowing what my net worth was every day. So and just through the process of watching it every day, I started asking myself, well, I wonder why the price changes. I mean, I literally knew nothing, but so I started watching other stocks. And this was the late 90s, so people were talking about stocks all the time, and it gradually got into it. And it didn't take me very long to realize that I wanted to find a systematic approach to managing my money that I had gotten from the IPO, and not to try to have to make the investment decisions ad hoc, but to come up with a process or a strategy of some sort. And it took me a while. I won't go through the whole long history of how I did that. But before too long, since I'm a software developer, I ended up starting to build backtesting software and use it to develop the kind of strategies I wanted to trade, and been kind of doing that ever since.
Okay. Now, trading from the 80s and the 90s, you've obviously seen there's been some interesting market environments over that course of time. So, logic would say that you would have had to adapt, which we're going to dig into deeper today. But firstly, why? So, as I mentioned, you're an undiscovered market wizard, which is a reference to Jack Schwager's not new book. It's been out for a while. Latest book, maybe I should say. So, can you explain a little bit about why Jack decided to feature you in that book?
Yeah, I actually didn't know he was working on a new book until sometime around the middle of 2019. And I got an email out of the blue from Mark Ritchie II, who's, I think his father is featured in one of the early Market Wizard books, saying, I'm trying to help Jack Schwager find people for his new book, and your name was recommended to me. And it turns out I was recommended to Mark by Pradeep Bond, who runs a website called StockBee, which is an excellent educational site for discretionary trading, which I've been a member of. I think I'm the only systematic trader there, but I've been a member of that site since 2013 and met a lot of great people there. But anyway, Pradeep was kind enough to recommend me, and I guess he recommended one or two others too, but they didn't want to be in the book. But I thought, sure, why not? I'll be in the book if Jack wants me to. And I luckily had very good records of my trading over all those years, which is Jack's requirement. And as it says at the start of my chapter, my stats were just barely good enough, but he was interested in the fact that I'm systematic. So here it is.
Yeah. Okay. Well, I think we've got a slide actually that shows your stats. So maybe we'll have a quick look at that so that we can get some context around your journey over the years. So let me just get that one up on the screen here. Okay. So what are we looking at here?
This is actually my actual daily trading results for my entire trading career since 1998 until now. And from this aerial view, it looks like a smooth equity curve, but actually there are some pretty significant drawdowns in there, which I think one of the subsequent slides will show.
Yeah.
So because of the timing of I had especially good results in the early 2000s when the S&P didn't. So I basically developed a big lead on it back then. If you take the excerpt of this since 2009, I'm not quite so far ahead of it, but I am still ahead of it.
Yeah. So obviously the blue line is your account equity, and the orange one is the was that say SPY? Yep.
Yeah, that's SPY. Yeah, and by time weighted return, I mean it's basically the daily percent change in account. So it factors out withdrawals because I trade for a living. This is since I left my job at the end of '97, and so I completely supported my family from this income. So therefore, there were a lot of account withdrawals.
Yeah. Well, let's have a look at the drawdowns then, because I can see one there around looks like about 2015, 2016. I know we've got a slide.
That's the bad one.
That's the big one. Okay, so it's pretty obvious from this chart where it is.
Yeah.
So what was happening around that time that caused that drawdown?
Well, it's sort of a long story, but in summary, I had changed my approach basically for 15 years or so. From the beginning, I was trading breakouts. I would buy breakouts and short breakdowns, so it was kind of short-term trend following. And the approach I was using more or less stopped working around 2013, and I discovered the mean reversion approach and added that at the end of 2013. I traded them in parallel in 2014. The mean reversion approach did so well that I decided to just drop the old strategies and put all my eggs in the mean reversion basket in 2015. And I just had no clue. So it seemed to just make money so easily and consistently. So I actually even leveraged it up a bit. And then there were a few bad drawdowns or bad periods for the strategy. One for the short side, one for the long side. And then one for both sides, from basically like June 2015 until January 2016. So had some bad losses in there, and shut everything down for a few months. And I actually had almost quit trading, but then so now I've invested a lot in this. I'll come up with a more conservative approach, and I've done pretty well since then.
Yeah. All right. Well, if we can dig in a little bit more into the impact that drawdown had on you, just looking at the charts, it's kind of small on my screen. It looks like about 40-45% drawdown.
Right.
Now you just mentioned that you quit trading for a while, but can you talk about the impact that had on your life going through that drawdown and then quitting trading for a while? How did that impact you and your family and your loved ones and things like that?
Yeah. Well, I mean, it made me kind of question my whole decision to quit my job 15 years earlier and trade. It's kind of unusual. It's an unusual path, I think, where somebody leaves their job to trade full time, does fairly well from the start, continues to do consistently well for 15 years, and then suddenly everything falls apart. But it could happen to anyone. And so at that point, I'm in my. I mean, now I'm 60, but I was in my mid 50s, and hadn't worked for 20 years. So even though I had a very nice resume as a software engineer in the 90s and 80s, I couldn't get hired very easily. I did actually, contact some former colleagues and consider going back to that work, and didn't really go anywhere.
Mm.
So I just decided to redouble my efforts on trading, and also to take my own software that I had been using all these years, and kind of gut it and do a major overhaul, and really polish it to a much higher level, to potentially market it. So I'm doing that now as well.
Mm.
Although it's, that's kind of a income wise, that's just a small thing, but I enjoy having people use my software. So
Yeah. Yep. So going from not trading to back into trading, what did you do? Was there a specific catalyst, or was there some steps that you had to take to kind of, I guess, heal the wounds and get back into the markets? Or how did you manage that?
it was mostly the passage of time. I mean,
Mm.
I completely stopped. I canceled a bunch of data services and subscriptions and so on, and I just thought I was done. And I didn't go so far as to close my brokerage account, but um, I think I moved most of the money out of it and into my savings account, and just kind of did other things for a while. And a few months passed, and then I kept thinking about trading and systems, and I just started dabbling in the backtesting software again, and trying some things. And the mean reversion strategies I had developed were still good. I just had traded them too aggressively. So I modified them a little, traded them more conservatively, um, and then I also made a plan. I've always had a system stop the whole time I've been trading of 20% drawdown, which means I need to at least pause and reconsider what I'm doing, and try to understand why the drawdown occurred, maybe
Mm.
change a few things. So I've generally done that. Um, so this time I made the system stop more conservative as well. I said if I have a 10% loss from the beginning, or a 15% loss from a future peak, assuming I make money, uh, I'll stop again. So that actually didn't happen, but knowing that was the plan helped. And I actually wrote a whole kind of trading plan or business plan for my new trading endeavor, which I had never done before.
Mm.
But I think that was useful.
Yeah. So did you have that 20% system stop in place when that drawdown occurred, or was that after?
Um, I kind of always had it in the back of my mind in the past, and observed it in the past, but that particular time, I didn't. I kept going. I kept thinking, oh, it's gonna come back soon. It's gonna come back soon. And that drawdown wasn't one move from the top to the bottom. It had some recovery periods, and then some further failure periods, and so on.
Mm. Yeah.
So yeah.
Yeah. So you haven't, looking at the equity curve we just shared, it doesn't look like you've had to test that 20% stop since then. Do you think you'll stick to it this
No,
time?
there was one that was pretty close, but
Right. Okay.
but it wasn't really. I mean, it's not like you can put a hard stop in your brokerage account. It's like, I don't know, maybe some brokers have that. Like, prevent me from trading when I reach this loss level.
Yeah. Yeah.
I know prop shops have that, but that's a different thing.
Yeah. Yeah. So I wanted to kind of dig into this a little bit more at the strategy level now. I just got a question here in the chat. I'll just put it up on the screen, which it's just a clarification on the drawdown we were just talking about. One sec. From Yen Trader. G'day, Yen Trader. Welcome. Was the 45% drawdown on the compounded balance with only draw money? Sorry, I've just misread that completely. Were the profits compounded? Was the 45% drawdown on the compounded balance with only money to live on taken out?
Those the data that was shown in the previous two charts is based on time weighted returns. So in real life, I don't compound. I mean, I do compound on a kind of a daily basis. And every day I'm trading with whatever's in my account. But in practice with the withdrawals, it doesn't end up looking like pure compounding, because you have to pay taxes on your gains, as well as living expenses and so on. So,
Yeah. Yeah, sure. Okay. So let's look at it now at a little bit more detail at the strategy level. Now, you've indicated you were trading mean reversion up until that drawdown, but obviously over the 20 years, you've used quite a few different styles of trading, and you've adjusted them as you've gone. Can you just give us a quick indication of how your trading style has adapted over time, and what type of styles you're using exclusively now?
Sure. Although, I mean, in a way, let me start with the similarities. That there's some things that have been constant the entire time I've traded. One is that it's U.S. stocks. It's U.S. common stocks only. I don't trade futures. I don't trade options. I don't trade anything else. ETFs. It's just U.S. common operating company stocks. And I've always traded both sides. Kind of decided from the beginning I didn't want to just bet in one direction. I wanted to have a long strategy and a short strategy. And my typical holding period is only a few days. So it's what you would call swing trading, I guess.
Yep.
Typically maybe 1,000 round trip trades a year. So no matter what type of strategies I've used, they've always been within those sort of parameters. Now, when I first started, I learned a method of breakout trading from a guy named Gary B. Smith, who was writing a column for TheStreet.com at the time called Technician's Take. And that column appealed to me because he talked about his process and his trading rules, and it seemed like a system. It was kind of a semi-discretionary, semi-mechanical system, and I started corresponding with him, and we eventually became trading partners. And so I was using that strategy, and had developed a fully automated version of it by 2000. And that approach is what I did basically up until 2012 or 13, which is you're buying a breakout on unusual volume in a strong stock that's been in consolidation recently. It's just it's probably the first setup everybody learns, right? And the short side is similar, although I also short strong stocks, not weak stocks. So you short a breakdown of a strong stock from consolidation. So that was the basic approach. What changed over the first 15 years was kind of the timing factor. So when I first started, I would scan for what trades I wanted to make after the market close and place the orders before the next open. So I would do all my entries at the open. Then after my first kind of 20% drawdown and retest and reset, I came up with realizing that results would be much better if I could do the entries right before the close instead of waiting for the next open, which makes sense if you think about it, because you're capturing the gain from all the other people who are buying the open instead. I used to like to say the only edge is being early, and so that way you're being early a little earlier. So that worked for a while, and then that seemed to erode. That edge seemed to erode until around 2005. I couldn't seem to make that one keep working, and I had to do a kind of technology reset and figure out how to incorporate whole market real-time data so I could be monitoring a lot of symbols all day for my entry signal. And so I did that and started basically it was the same setup, but I was looking for the entries from right after the open of the breakout day rather than waiting till the next day. And that worked really well up until 2013 or so, when that seemed to, especially the short side. The short side dramatically failed from about the summer of 2012. That's when people started focusing on buying the dip.
Mm.
There's a popular YouTube video about that.
Yeah.
BTFD. The so that basically killed my shorting strategy. It was literally the opposite of other side of my shorts was what that thing was. And if enough people do something that's the opposite of what you're doing, it's usually not good. And that's what led me to look at mean reversion, which is essentially what BTFD is, kind of a mean reversion strategy in a way.
Yep.
And so I did both in parallel in 2014, and then switched to mean reversion, and then I did only mean reversion. Even when I restarted in 2016, I was still only doing mean reversion, but in a more conservative way. But I was also looking for other things to add, and I did come up with new versions of more short-term trend following type strategies to add in, so that I could have 4 things running. And then last July, I added another 2 pair of strategies, which are mean reversion with a shorter time frame. They're day trade strategies. So now I'm running 6.
Okay. So when you're explaining some of those, the evolutions of some of those strategies, it sounds like you had an understanding of why the strategy was performing at that time. For example, you said, getting in earlier seemed to give you a better result during that period of time. Do you think it's important to have an understanding of what the edge is, or why a strategy is performing in a way that it's performing at that time?
I would say so, at least on some level. I mean, you never really know, and in a way, any strategy works because it anticipates what other traders are going to do. And gets you in before they do. But yeah, I think it's important to understand why. I mean, the breakout thing I was doing early on is I think it works because it's so well known. It's the same thing that William O'Neill wrote about in How to Make Money for Stocks, and that Investors Business Daily prints about, and so you got a lot of people looking for those kind of setups, and if you can be a little quicker than most people and get in front of them, then you can do well with it. So that worked until it didn't. I mean, and mean reversion is a little different. I mean, it just works because you wait until there's been a kind of an extreme imbalance, buy when there's just been an extreme amount of selling, and vice versa, and that just tilts the odds in your favor a little. But so yeah, I think it's important to have some kind of, at least a general understanding of why it is. You'll never know exactly why something works.
Yeah. You made
if there was an exact reason, it would work all the time.
Yeah. You made an interesting point a little bit earlier about how you were doing mean reversion, but you were doing shorts using the opposite logic of the long. Is that what you said? Or did I imagine that? I think that's what
I
you
might
said.
have said something like that.
Yeah.
The mean reversion short, they are the opposite. I mean, the mean reversion short is shorting stocks that are extremely overbought, which works really consistently and nicely most of the time, except every now and then it works really badly. Like in January of this year, for example, when fortunately, this did not occur to me in real life, but I actually have an example strategy that comes with my software that would have shorted GameStop and had a horrendous loss from that particular trade.
Yeah, I think generally traders find it more difficult to build mean reversion short strategies than long. Now, there's some skew in the market, depending on which markets, but I guess in the stock market you're talking about. Why do you think it's so difficult sometimes to build mean reversion short strategies?
Well, I mean, some people make the mistake of assuming that you should, because a lot of well-known mean reversion long strategies include an uptrend, a long-term uptrend filter, like the stock has to be above its 200-day moving average, for example.
Mm.
And I think the strategies include that filter mainly because it makes back tests work better in 2008. But anyway, so I think a lot of people who look for short mean reversion made the mistake of trying to do that in reverse and say, oh, it should be in a long-term downtrend. But then you get value investors, dip buyers, and so on buying those, so they don't tend to actually make good shorts. If something has a short-term rally in a downtrend, that's kind of a buy signal for certain kind of traders. But whereas when something is making a blow off top after a long uptrend, that can be a very good short entry point. So that's the kind of thing my strategies look for.
Yeah. Now, I think you, when you're talking about the strategies you trade now, I think you said you trade 6 strategies, a mix of mean reversion and momentum, I guess. Now, I think that's because, at times mean reversion works well, as you mentioned, and sometimes it doesn't work so well, but you're hoping that other strategies are going to pick up the slack. I guess, though, the challenge with doing that is, how do you know when a strategy's broken compared to whether it's just underperforming, but it's within its expectations? I mean, that's always been a tricky question to answer. How do you approach that?
I've never had a good answer to that question, which is ironic since that's the title of this whole podcast. But I mean, I know I've heard some other guests you've had even who have a very systematic approach to that. I think even maybe our mutual friend Kevin Davey is one of them. But I mean, there's certain things you can look for. If you have a bigger drawdown than it's ever had in a back test, that's kind of a red flag. Although doesn't necessarily mean it's dead, but it might. But a drawdown is just a one-time event, so you don't necessarily want to read too much into that. But if enough time passes and the stats just seem to be like all the stats seem to be in downtrends, that could be a sign that it's broken. I don't necessarily have it as a binary event where I run something one way until I say, okay, now you're broken, so now I need to replace it. It's more like I'm always tweaking my strategies and making little changes. So I might not even notice kind of it's broken event. And it's typically taken me too long to, like with my old shorting strategy, I waited way too long to admit that was broken and shut it down. And now in hindsight, I know that it didn't actually come back and start working again. Although I've been able to find a kind of a variation on it that I'm using now as one of my 6, but it's rather different.
Yep.
But in other words, there's a fair degree, at least for me, there's quite a bit of intuition involved as well, in that process.
Yeah. You've prepared a couple of slides actually, which might be a good time to have a look at it. An example of uncertainty. Shall I bring those up and we can go through?
Yeah, sure.
You've got some nice examples here.
Example.
Yeah. Let me get. Here we go. I think this is the first
so here,
one.
Yeah. This is something I just every now and then I'll go back to the kind of strategies that I traded for my first 15 years and see if I can come up with versions that looked good recently. And one thing that I've improved at in recent years is I used to have a lot more parameters and do a lot more optimization. Now my software includes a really nice optimizer, which I never use. I have just very few parameters and I'll just choose simple values. But anyway, it's the basic concept here. It's a long and a short strategy pair. So it's like the long side is entering is looking for a big breakout on high volume, like I used to trade. But then it's entering on a limit order the next day if there's a little pullback after the big breakout. And the short strategies the opposite. It's looking for a big breakdown and entering if there's a little bounce on the short side. So and this does better. If I try to test now my actual strategies that I used to run in the mid 2000s, the equity curve just slopes downwards. They just really don't work anymore. But this one is sort of okay. It goes sideways, but still, I mean, if you look at, I wouldn't add a strategy to my list of things to trade that only makes 3% a year and has a 17% max drawdown, which is what the stats say there. And this is a 10-year back test. So based on these stats, I would reject this. I'd say, okay, good try, but I'm not going to trade it. But as it happens, go to the next slide.
Next slide. Here we go.
So this is what happened with that exact same strategy over the next year and a half. Now, to me, the main thing this says is that 2020 was a phenomenal year. I mean, practically anything I test worked well in 2020. So I think my chapter title is especially applicable for everybody in 2020. But so I don't know. These look pretty good right now, and even especially in last week, it looks like they made the long side did especially well. Maybe I'll need to do a little more research on these.
Yeah,
but that's a tough call. I mean, do you trade a strategy that was a dud for 10 years and now has done great for the last year? Maybe. But then you have to kind of make a judgment. Is it a regime change or a temporary blip?
Yeah. Do we have some more examples after this one? I don't recall.
I think there was some with this is that the example mean reversion shorting strategy that I include with my software, and this is how when you see the dollar figures in the y-axis, it's non-compounded. I won't get into why, but I tend to prefer running back tests without compounding. But anyway, just focus on the shape of the equity curve. It doesn't really matter if the numbers are compounded or not. If it was compounded, you'd use a log scale, and then the equity curve would be the same shape. So anyhow, that's a typical smooth, good results of this strategy in most time. So this was 95 through 98. So based on that, and I didn't put the actual stats, numeric stats in, but they're ones that I would say are good enough. But then, so that does not predict what happened next. Now, of course, we know that that 1999 was not going to be a good environment for shorts, and actually, to its credit, this thing didn't get completely clobbered. It only maybe lost half the account. But yeah, that's. I mean, you can when you're not compounding, you can just look at the numbers for percent. You started with 100K and you ended at 50K, so that's a 50% drawdown. So based on that, if you had just looked at this back test, you'd say, yeah, I'm not going to trade that strategy. And then look at the next slide, which I think shows that's basically the last two slides put together.
Right.
So it worked really well, then it worked really badly. So if I was looking at this, I would say that strategy's broken. I'm never going to trade that. And I would have missed out on the following slide, where over the next couple of years, it made phenomenal returns. I mean, it made 60% in 2000 and 100% in 2001. You get the idea. So sometimes it's hard to tell.
Yeah. So what's the lesson there then?
Well, there's a couple of lessons. First is mean reversion shorting is a dangerous game.
Yeah.
And if you use these kind of strategies, you want to keep the position sizing pretty modest. But then also, I don't know if you included the one where I put a moving average on the equity curve. But with mean reversion strategies, that technique works pretty well, actually.
Is that this
one? Yeah, that's the one. So this is the same strategy over the entire time from 95 till the present, where the orange line is the raw strategy and the blue line is the strategy using its own equity curve 300-day average as an on-off switch. So it reduced the drawdown in late 90s by about half, and it completely avoided the terrible drawdown in the start of this year in that particular strategy. So that's something that you can play with. Is using a strategy's own equity curve, and I've done that in real life a couple of times. I don't do it as a kind of rigorous practice, but I used it as an input. There was a long mean reversion strategy actually in early 2020. I was noticing that the results seemed to be deteriorating, and I looked at the moving average of my equity curve, and it had gone below. And I said, okay, I'm just going to turn this off for a while. And it turned out I avoided some of the losses that I would have had in March as a result. So that worked out well. So now I do tend to look at that. Although, I'll use my judgment as well, but it's a good input.
So where did the 300-day average come from? Why not 250 or 200 or 500?
Actually, they all work pretty similarly.
Right.
I can't even remember why I chose that number.
Because earlier you made a statement that you've got a great optimizer in your software, but you don't use it. So what's your approach to optimizing?
Oh, I'll use it occasionally, but I mean, what I use the optimizer for is to run through, to pick a key parameter and run through some values and make sure that it's robust. That there's a whole range of values that all produce acceptable results. But now I tend to just, rather than going through the trouble of adding a named parameter and then putting it in the optimizer, I'll just type a different constant and hit run again, and then I'll try like 3 or 4 values off the top of my head, and do it that way instead. My backtesting software is extremely fast. So, because for me, I don't know, I might have ADD or something, but I'd like to be able to just work interactively and just try something, see the result, try something, see the result, try something, see the result, and have, like, if it's going to take long enough that I'm going to open a web browser and start reading a blog or something, then that's not good. So, try to work in that, get into a flow state of creative research.
Yeah,
I think that's important.
Yep. Okay, we've got quite a few questions in the chat, which I want to get to in a minute, but I've got one more question here I really want to ask you before we get to that. And it's a quote from your interview with Jack. And that quote is, "I had developed an understanding that the pace of the markets was speeding up." So a couple of questions on this. How did you even notice that? And how did you adapt your trading strategies to that observation?
Yeah, that was in particular a reference to in my original strategies, how, as I mentioned, I had at first it was fine to enter at the next open, and then I realized, and that didn't work as well, and I had to enter at the close, and then that didn't work as well, and I had to enter earlier in the day of the breakout day. And I also specifically observed and got confirmation. Somebody explained to me in the early 2000s that because he was a trading partner I had then, and he knew someone who worked at a trading desk of a mutual fund. And he said, the mutual funds are changing. They're not trading in blocks they're not having human traders do big block trades anymore. They're having algos do it now. This transition happened, especially in the early 2000s. And coincidentally or not, around 2005, when my end of day entries stopped working, is around when the mutual fund industry had made that transition. So that's you could call it speeding up in that, although in that case it's sort of slowing down in a way. But yeah, the speeding up aspect is also in terms of news propagate. I mean, a lot of it has to do with the internet, right? I mean, news propagates faster, people react to things sooner, and so on.
Yeah. So do you see that still speeding up today? I think the markets are getting...
I would say so. I mean, I think certainly this year we've seen some ridiculously fast, high amplitude, low period moves. And I have done well by adding a pair of shorter term strategies to my trading since mid-July. So I think that's a further. I mean, I don't know where I'll go from there. I don't think we can all become high frequency traders. So at some point, there's a limit there's a speed limit. But
yep, absolutely. All right, thank you very much, Marsten. Now I've got some questions here in the chat, so I might just pop a couple up and we'll have a discussion about them. So we've got one here from Jabba Jaw. Let me put this one up on the screen. G'day, Jabba. Thanks for the question. Do you track previous strategies in case that system comes back in favor?
Yes, I definitely will do that. And I used to do it a lot more. I mean, I used to when I was trading different versions of the breakout strategies, I would keep every single version I had ever traded, which were really the same strategy with different parameters for the most part. And I would actually just go through them one by one and see which ones had done well recently and which ones had not. And that actually helped me gain an appreciation for how much randomness is involved. Because I could see that this version did better, that version did worse, but I couldn't explain why at all. So that helped me get away from using all the parameters and re-optimizing when I realized that there was no cause and effect to which set of parameters would do better in the future. But in terms of the broad concept, I mean, like that slide that we showed earlier, the strategy that was mediocre from 2010 to 2019 and then did well in the last 2 years. That's an example of me going back and revisiting what I used to do. But overall, I've actually traded relatively few types of strategies in my career, so there aren't that many to go back and review.
Yep. Okay, thanks for answering that one. Here's a question from Ola. G'day, Ola. Put this one up on the screen. Do you adjust your position sizing depending on a strategy's performance?
A little bit. I don't. So far, I haven't made that as part of the strategy itself. Although it's something I want to play with, because now with my software, I can actually backtest that pretty easily. But I have done it ad hoc a little bit. For example, in 2020, I reduced the position size a couple different times of my mean reversion strategies as I saw the volatility increasing after the March breakdown. So the answer is yes, but not systematically. I mean, something about me in general is I'm completely systematic and mechanical at the individual trade level, and almost completely discretionary at the system design and implementation level.
Okay, that's interesting. I've got a question here that kind of leads into what you were just saying. This one's from Jones. Let me pop that one up on the screen. What was the process by which you initially developed the strategies you use?
Well, the first strategies that I used for 15 years, I didn't even really develop them. I learned them from Gary B. Smith, who I had mentioned earlier, I first started building the backtesting software because I wanted to. We were using discretionary entries and mechanical exits, and I wanted to be able to test the exit rules for the entries we were actually taking. So I did that, and then that led me to want to start trying different variations of the entries to see if I could make it rule based, and it kind of evolved from there. The mean reversion strategy ideas, I actually hadn't heard of mean reversion trading until I started looking for new directions in 2013 and joined StockB, and I was posting on there about the trouble I was having with my systems, and a couple of people recommended I look at mean reversion. So I got a few books and started testing that concept. And at first I wasn't comfortable with it, but I just kept testing it and trying it, and then traded it live really small and got comfortable with it. More recently, I got another idea of a trend following strategy that from some people on StockB also. So yes, ironically, I get some of my better ideas from discretionary traders.
Yeah. Okay, thank you. We've got a couple of questions about your software, which we'll come back to at the end. Here's another question from Yen. Okay, let me put this on the screen. How do you differentiate from tweaking an existing system and it becoming a whole new system, but now with recency bias to the current regime, which is bound to fail as the regime changes?
Well, I mean, I think it's kind of a continuum, really. I mean, there's the smallest kind of tweak would be taking the exact same rules but just changing a parameter. The next level above that would be maybe adding or subtracting a rule or two, but most of the rules are still the same. I mean, like for example, if you take this strategy that looks for a breakout on unusual volume from consolidation in a strongly trending stock, and you enter on the breakout day versus entering the next day if it pulls back, that's a tweak. And that might make the difference where one version works well for the next year and the other version works terribly for the next year. So I wouldn't even think of that necessarily as a regime change. In my experience, I haven't experienced the idea where the regime change, it completely breaks the strategy. Well, maybe my old ones in terms of how they entered, it stopped working, but
yeah. Okay.
Sorry, not a great answer. But
No problems. Okay, this one is from John. Thanks for the question, John. Could the speeding up of the markets suggest a shorter term optimization and backtesting?
Yeah, certainly. I mean that I've done this year with adding some shorter term strategies. Although my philosophy nowadays is to try to encompass everything, because in some ways things could slow down again, even, for example, even this year, there's been a couple of weeks when some of my strategies do great and others do terrible, and then the next couple of weeks it'll reverse. If I have one overriding philosophy now, it's to trade several different kinds of strategies at the same time, so that are not all correlated.
Yep. Okay, I got a question here from Thumper Bumper. What a great name. I'm not sure what it means, but I like the sound of it. Let me put this one up on the screen. And an earlier comment from Thumper said he or she loves slides. So, but this question is, what is the target volatility range or minimum volume for the equities you trade?
Oh yeah, I meant to talk about my trading universe. I've always approached this the same way. I basically want as broad a universe as possible. So my only constraint is that it's a regular U.S. common stock. Like I try not to include limited partnerships or preferred stocks or that kind of thing because they don't really go anywhere, and they're annoying for tax reporting. And then I just use a price and average volume. So like typically I'll want price greater than $10 a share and average volume greater than 100,000 shares per day. Yeah, and more recently I've also had a generally a minimum volatility requirement of like I use ATR, so ATR of at least 1%. And for mean reversion strategies, you want a higher one. Some of my mean reversion strategies require at least a 5% ATR, because basically the more volatile, the better for mean reversion, which is why you have to keep position sizing small. But I've never embraced the idea that volatility means risk, so I don't measure it that way. Like I don't use volatility as a risk measure. I use it as a minimum acceptable volatility because I'm not interested in trading things that aren't moving.
Yep, that's fair enough. We've got a question here from Jones. What about your use of indicators? Do you are you reliant on indicators, and if so, what do you like?
I use very few. I mean, most of the rules that I use are just based on price changes, like what is price done versus its recent versus the lowest price in the last 10 days or something like that. But as far as the indicators go, I think the best ones are all the ones that Wells Wilder developed. So ATR, RSI, and ADX, basically. Those are the ones I'm most likely to use. ATR in particular is that plays into a lot because okay. So that I'm going to contradict what I said earlier about volatility. I do use ATR a lot, but I use it more in measuring, like how do you define an unusual move? So in ATRs is a good way to do that.
Okay. A question here from John. Let me put on the screen so you can see it. What is the practical difference between a diverse system of, sorry, my screen just jumped. Where's the comment? Diverse system of simple systems and a complex optimized single system?
Well, I suppose it could boil down to semantics. If you had a single system with all these different rules, so that it effectively was, it's like if a stock breaks out and does this, then go long, or if it pulls back this much, then go long. I mean, you're kind of combining a breakout strategy and a mean reversion strategy in one system. But I find it most useful to define them each as a separate strategy in my software, and then you can see their equity curves independently and see how they interact, and even look at the correlation matrix and so on. And by letting them be separate things, it's easier to test.
Yeah, sure.
So it's more of an implementation, but yeah, at some conceptual level, it's the same thing, I guess.
Yep. Okay. Well,
I tend to use the word system as to mean a collection of strategies, and then each individual strategy is like this, what you might call a simple system. And when you combine them all together, that's the system.
Right. Yep. Okay, we'll do one more question here from Simba, and then we'll we'll address the questions about your software and start wrapping it up. So this one's from Simba. G'day, Simba. Thanks for joining us today. Hey, Marsten, do your systems look at the overall market regime and trade differently? Or do you prefer to use multiple robust strategies that behave the same in all regimes?
I don't currently use any regime. Well, that's not true. One or two of my strategies require that this. Okay, let me back up. I don't use an overall market regime filter to say, okay, the market is now bullish, so therefore I'm going to overemphasize these strategies and underemphasize those. I don't do anything like that.
Right.
I've always kind of taken a bottom-up approach. So I'll take individual stock, like I'll use a longer-term trend filter on individual stocks within a strategy, but that's different from market regime. But that will mean that strategy will tend to not find very many. Like if something requires, that it's above a 200-day average, it's not going to have any candidates when you're in a major bear market. So it's another way of implementing a regime filter is to do it at the individual stock level. And the advantage of that is when one sector is in one regime and another sector is in a different regime, you can still trade the one that's favorable to you. So I prefer the bottom-up sort of approach rather than whole market regime filters.
Yep, sure. Okay. Now we've
also all of my strategies are short-term. My holding period is only 5 days or so on average. So regimes at that time frame are it's a different story. You can have regimes within regimes.
Okay, well, we'll start wrapping up here. There's been a couple of questions about software. So can you share how people can find out more information about that and perhaps even get in touch with you?
Oh, sure. Yeah, I did at the beginning of this year decide to start marketing my backtesting software, and you can go to mhptrading.com, and there it is on the screen, and everything you need to know about it is right there. You can see an overview of it, read the documentation, get a free trial, and I also run a forum which is only for people who are using my software. I keep it gated, but it's not just how to use the software. There's pretty good discussions about systematic trading in there as well. So it's kind of like a community of users of it. So yeah, I welcome anyone who's interested in this to try it. It's many people who have struggled with something like OmniBroker have found Realtest to be a lot easier. Doesn't really require programming. The way I like to say it is if you can build an Excel worksheet with cell formulas that calculates some things, if that's not a struggle for you, then you can probably learn to use Realtest. You don't have to be at the level where you can build a whole framework in Python or like write a complex VBA macros in Excel.
Okay. So I think I saw a question in the chat about a scripting language. So it doesn't need you don't use a scripting language?
It does. It does have its own scripting language, but it's not a programming language, really. It's just a way of, Realtest is kind of like a very general purpose trading system model, and the scripting language is providing all the inputs to it. But any of the inputs can be a formula, and the formula can be any expression. Kind of like in Excel, you can put practically any formula you want in a cell of any complexity. The same way with Realtest. So like a formula, like one of the inputs would be entry setup, which is basically the condition which makes a stock an entry candidate on a given day, and you can put anything you want in there, any combination of typical indicators or whatever. But it just has to be expressed as a formula, a one-line formula. Although then there's something called the data section where you can build up more complicated calculations, kind of like adding columns to an Excel worksheet.
Yeah.
So
okay.
That's kind of the level it's at.
Yep. All right. So people can find out more information on mhptrading.com. So we'll also have a link just below the video. Did I say that right? MHP trading.
I love it. Makes it much easier to know what the actual letters are.
Yeah. I thought maybe I said MPH, which is obviously not your initials. So mhptrading.com. Yeah, thanks a lot for today, Marsten. I feel like we only really scratch the surface of what you can share, but we've had a lot of comments in the chat today. So, yeah, do you have any final comments or statements before we finish up?
Yeah, thank you. I agree. We only scratched the surface. I tend to do much better in writing than speaking. So there's a lot of interesting stuff in my user guide, and one of these days I'll stop working on the software long enough to start a blog, because I do feel like I have a lot that I want to write. And one of these days I'll make some tutorial videos and so on that will be useful as well. But
Yeah.
right now, try it. You'll like it, is what I can say.
Yeah. Okay. All right. Well, thanks for sharing. We've got a couple of thanks in the chat, so I might just share a few just while we finish up here. So Jeff said thanks. With some good questions from Jeff and John. And here's RDE. Thanks for taking the time. So yeah, lots of love for Marsten today. Thank you very much. And don't forget to hit subscribe and like if you enjoyed the content today, and make sure that you don't miss out on anything in the future. We'll be back next week, so 7 p.m. Central USA time, and we will catch you then. My mouth has just stopped working
Andrew.
all of a sudden. Yeah, thank you very much, Marsten. Thanks everyone for joining us today. Have a great week. Cheers.